Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, will provide you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Well, thanks for joining us and coming back, and for tuning in to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition. The Real Estate 360. It comes to you daily, Monday through Friday at 3 p.m., along with co-hosts Joe Kuchera and Lori Graymont. Make sure you tune in the other days and catch their programs on a variety of subjects covering real estate in not only the area, but throughout the nation, and fundamentals that certainly apply to the world. If you can't make the show live, you can catch your podcast on RE360radio.com or my programs on TomWilsonProperties.com or on iTunes under Wilson Investment Properties. So encourage you to go look at that, see its subjects that appeal to you, and guests, and listen to them. We have a great program for you today with our guest, Michael Shelton, who's an appraiser that I've known for about 12 years. He's in the Dallas-Fort Worth area, but most of what he'll be talking about certainly applies to, any region, because the guidelines are driven primarily by federal standards, not by regional. And Michael Shelton has been he's a fourth generation investor in real estate. He's a licensed real estate broker, loan originator, and a certified appraiser for many, many years. Always enjoyed working with Michael because he's so knowledgeable about all the elements that affect the business, and I've learned a lot from him, and we're delighted to have him on the program today. Hello, Michael.
Hey, Tom. How are you?
I'm just fine. So thank you so much for being on the program today. I think for those out there who are thinking, appraiser, that's just something that the lender and has to worry about in title company, and that just check the box. I think you'll be quite surprised to learn that it's a lot more than that, and many variables and factors contribute toward what an appraisal comes out to be, and who's doing it makes a lot of difference. In this day and age, we don't have a lot of control over directing that, but at least if you understand the rules of the game and the system, I think you'll be able to prepare for and address and deal with that part of the important process of buying and selling real estate a lot better. So, Michael, to start off, give us a little background as to how you became an appraiser and how long you've been doing that and so forth.
Well, we've been when I first started licensing back in the late '80s, early '90s is when I first got my appraisal license. But, as you had mentioned, we've been, as a family, in real estate for a long time. And what got me to actually choose the path of being an appraiser was working as an intern with one of the nation's largest commercial brokerage houses. And I'd gone to lunch with some gentlemen there trying to discern my path on if I was going to go brokerage or appraisal. But the fellow's car that we had taken to lunch happened to be a real estate broker, and when we came out, his car was gone. It had been repossessed. It was in the late '80s, and he hadn't closed the deal in quite a while, and so I thought that the appraisal pathway was going to be a little bit safer and easier for me to traverse.
And what's your conclusion about that decision?
Well, that same fella came back later and became a multi-million-dollar producer. So, the brokerage side has a lot of highs and lows, and as long as you mind your P's and Q's and stash some money away, I think that, if that's your skill set, that's certainly a lot more money in that. And then on the flip side, the appraisal pathway is more like the tortoise and the hare. It's the slower, more steady income and a more steady way to acquire wealth.
At the peak of volume last decade, how many folks did you have working for your business?
Well, we had about 15 in the office at any given time. Usually it was 3 office staff and 10 to 12, 13 appraisers. And my goodness, I mean, that was, quite an exciting time. We, I think our peak was somewhere around 50, 60 orders an hour, coming in. It was, in the peak refi boom, it was just crazy.
50 to 60 an hour?
Yeah, we had one day where we just finally had we kept running out of fax paper back in that day. And that was what caused us to quit taking orders that day. Was gone through all the reams of fax paper that I had, and so it was kind of like going on your credit card till all the numbers were out. I mean, all the paper was gone, so we were full.
Well, let's get into the meat a little bit of appraising. I've often told folks that the true value of a product in a free market of a house is whatever price the buyer and seller are agree upon. But of course, in this regulated world that we're in, that gets skewed a bit. So, how would you give a little overview of your thoughts of how the house values vary because of the appraisal process that's run by the federal regulators versus a free market?
Well, it's kind of like borrowing money from your parents or your great uncle. I mean, they always get a say in whatever it is that you're doing. So if you've got cash, you can afford to pay and negotiate your own sales price at whatever terms you want. But when you start, trying to leverage and utilize other people's money, then they get some say into, what you're doing. And it's surprisingly, I think, liberal in that, you're purchasing a property with as little as 5% down, and yet you still get to choose, a lot of the factors. But you're right that it's not a clear, capital market when you're having to go through the federal regulations. Anything government related is slow and cumbersome, tedious, and it's kind of put into place to be a governor to keep prices from escalating too quickly. And unfortunately, I don't think it keeps prices from falling as quickly. They still seem to go on the downside much quicker than they go up.
So what do you think, with government involvement, what do you think happens to prices on the upside?
Well, it's slow, and it's always a struggle in an up market, and that's a market that we're entering now in a lot of submarkets across the nation, and people are bidding up properties to the full list price. Even the REOs are selling at full around here, full assessed values, full list price, and it's a struggle when you did one appraisal the other day when they had 5 offers over the list price. And so to get that through underwriting is a struggle. You have to really document why that's occurring, and even go as far as in this particular case, we documented the other offers that have been received and how the buyer took the offer that they did take, and verified that the other offers were real offers. I called the agents and put all that in the report just so that you could say, hey, it was listed for this, but we came over the list price because of these factors. There's nothing on the market, a really desirable house. Here's what the other people were offering. And luckily, I still had some sales comps recently consummated in that neighborhood that supported the final sales price. So it's a struggle. It's that it's going to get caught up in underwriting. There's going to be a lot of questions and a lot of people not wanting to put their necks out for that kind of a transaction. But if it's there, you can if you're tedious enough and patient enough, work through all the underwriting obstacles that come up.
Would you say that one reason that the prices are held back by government involvement is just just the fact that appraisals, by definition, have to look to the rears, even though the market's moving forward.
Yeah, and it's what reminds me of that, and I think it was Dr. Seuss called it a push me, pull me, but it was a llama-looking creature that had a head on both ends. And you're looking two different directions. Brokerage and salespeople are looking forward and headed in that direction, and us as appraisers are always looking backwards to try to figure out where we're going based on where we've been. And it creates quite a conundrum whenever those are the two viewpoints, basically, in the transaction, and you're trying to get them to meet somewhere in the middle.
To what degree is an appraiser allowed to make adjustments for the direction, movement, rate of change in the market?
Well, of course, it'll come down as a general guideline, and how about very little as far as an answer goes? I mean, the general guideline, that makes everyone nervous when they start seeing time of sale adjustments. The market's changing too quick. What if I'm the wholesale lender? Can I get this, note moved before, something looks, considerably changes in that market? Can I get some third party to buy this note in time and things like that? So it makes everybody, more cautious when you see that. And as a result, we can, put some market adjustments on there. I know in California, you guys have been a lot more liberal with that type of underwriting in the past than Texas has been. But in general, I mean, if you can really support it and you've got a lot of documentation, you might be able to get away with, half a point a month or, something like that, which I don't know. Sometimes the market's moving a lot more than that, so I don't know if you ever can recapture everything that you can prove, but that it is, once you start doing that adjustment on a Fannie or Freddie appraisal, and when you start trying to follow those guidelines, it just, underwriting gets to be a lot more difficult. So it's better if that's your last resort.
So it does vary by the state. There is some variation. We have just a moment here before the break. Is that the case? The guidelines?
It is. They're national guidelines, but then they're enforced, locally. So it does vary by your region.
Okay. We have with us today Michael Shelton. He's a longtime experienced appraiser and real estate investor from Dallas, Texas. And he's talking to us today about the whole appraisal process. We'll be back in just a couple of moments here, and we're going to talk about the different elements that affect an actual appraisal, get a feel for that. So stick with us. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. For more information on today's program, visit RE360radio.com. That's RE360radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We have with us today guest Michael Shelton from Dallas, Texas on the call-in, talking to us and teaching us about the appraisal process, which is a much more significant part of the whole real estate transaction than many people realize, and certainly very critical. So Michael, how significant are the regulations affect and determine how you go about it?
Well, the underwriting standards and the regulations, and we have an ethical standard called USPAP that's just for appraisers, and the USPAP is more or less our Bible, and it's the code of conduct, basically. And then the underwriting standards on what the different banks and the insurance companies that are underwriting loans, that's what they're looking for. If you can appraise a home based on these standards, that's how they'll insure it and get you the mortgage rates that you're after, and the really liberal terms that you're after. And so that's everything in the appraisal standard. They, as they're asking you to go, value a property, they really want to know, the immediate market, how how is that reacting to the current situation, and how does your house fit into what the other players are on the market. And so it's more like what color glasses you put on, what color shades when you're looking at the house. And so the lender, when they order the appraisal, tells you which standards to use, and then so you pick up those colored lenses and you put them on, and then you look at the house.
And you're caught in you're in a delicate balance, aren't you? You've got pressures out there that want the house to appraise as high as possible, and there are others that are worried about risk and want it to appraise as low as possible, or at least to be a flag if it looks like it's being sold beyond what the market would reabsorb it as if the bank had to take it back.
Right. And I mean, the appraiser is always everyone's ugly stepchild, but they just kind of put up with us because we're part of the transaction, but nobody claims you at the end. So, but really, we're there to try to protect the bank's interest and the borrower's interest. And they hate to hear that if they happen to be paying too much, or there's just no way that this particular transaction is worth as much as what they're wanting to pay it. But at the end of the day, it all seems to work through, and you hopefully everybody can at least agree that it's a good transaction by the time everybody gets done.
So how many thousands of pages are there regulations, or how you were mentioning during the break there about how many books are sitting in your office there?
Well, up above my desk, we have Fannie and Freddie and HUD and VA and all these different underwriting standards, and there's probably 24 inches thick of just solid appraisal guidelines and regulations above my desk, so that when somebody brings up something, you can at least look up there and figure out if it's we get called for a lot of underwriting guidelines that turn out not to actually be true. So, it's always to have them close by so that if something's stuck, and you can at least refer to the source documents and see what they're trying to get to, or, what somebody's actually asking. And to get your appraisal to fit through that many different layers of guidelines is a feat in itself.
And the two organizations which regulate it are what?
Well, for insurance and that type is Fannie and Freddie and FHA are the major players, the three major players. As far as USPAP goes, that's the Appraisal Standards Board or the Appraisal Foundation, and they answer to, they're directed by Congress to come up with the USPAP standards. And then the underwriting guidelines come from the different, whoever's insuring the loan.
Is there do appraisers get audited on a regular basis?
Only if there's a problem. If we don't have to usually turn in our records. We do when we first get licensed, and then after that, you only get audited per se if there's some kind of a complaint filed against you, and they'll go back and look at your last 2 or 3 years worth of work.
Mm-hmm. Yeah, well, I certainly know from experience that your files are always very complete and thorough, and I don't ever remember anything coming back from the underwriter, which is why we loved working with you, and hate that we can't select whom we want to work with these days. We're going to be back after a break here. We're on KDOW, 1220 a.m., Wall Street Business Network. We have Michael Shelton with us, an appraiser in Dallas, Texas. We will be back with you in just a couple of minutes. Stick with us.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. For more information on today's program, visit RE360radio.com. That's RE360radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We have with us today special guest Michael Shelton from Dallas, Texas, who's calling in with us today. And Michael is an experienced appraiser and investor, and he's explaining to us the process of the appraisal. Michael, tell us tell us what the factors are that affect the appraisal price that you wind up delivering.
Well, the old adage is location, 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 and that's certainly true in the appraisal. And that, when we're valuing a property, we want the comparable sales to be right there in the same, have the same market influences and factors as the subject property does. And so that's probably the greatest thing. And the one thing that there's not a lot that a homeowner or seller can do about the location. It is what it is. So the second most important thing would be property condition, and that's the one variable that you have some influence on. You can certainly look at the remodeling magazine, cost versus value type information, and you come up with what you need to do to the property to make it compete in this marketplace as well as possible.
Michael, I'm surprised to hear you say that. Wouldn't you say that square footage is a stronger variable than the condition?
Yeah, well, it's going to be based on your
location and then square footage and then condition.
Yeah, I would agree with that. That in general, most of the houses in a certain subdivision were going to be built at about the same time, built by the same pool of builders, and so in general, if you're in the same subdivision, most of the houses
about the same size,
forms of each other. But you're right. In some markets, that's not true. And, you'll have a 5,000 square foot home, especially here in Texas and down around Houston, where there is no zoning. I mean, you can have a 5,000 square foot home next to a 900 square foot home. And so, in that case, you're right, square footage becomes a bigger factor.
And especially more in normal times, right? But when we're in this, been through this very distressed period of time, I think we have a lot bigger variation in condition in the past few years than we generally have in the past, right?
Right, and all the distressed homes that they sifted through and came on the market, all of them had, not all of them, but most of them had, property condition issues that you wouldn't find in a owner-occupant transaction. But you're right. I mean, you have these limitations on the sales comparables that if you're having to adjust them more than 15% net or 25% gross adjustments or a 10% variance in your square footage adjustment that generally those don't fit the Fannie Freddie model for similar sales. So if they're outside, if you have to make a lot of adjustments to a comparable, then it's not on the single family side going to be considered comparable. That's not really an issue on commercial, but it is on the single family side. So
if you're in the same neighborhood and you have the same square footage, two different houses, how much variation do you see in this past few years between a distressed home and that's trashed and a home that's fixed up and nice?
Almost always there's going to be, until this year, there was almost always about a 20 to 30% variance. This year, there's so few houses in inventory that, as what we were mentioning earlier, that in our market, in North Texas market, that people are bidding those right up to the full retail value.
Yep. So there's so it's narrowed that gap just because of so limited supply.
Yes, sir.
Yep. So we have Michael Shelton with us today, an appraiser, very experienced appraiser in Dallas, Texas, and we'll be back in a couple of minutes to continue our discussion with the appraisal process. This is Tom Wilson with KDOW AM 1220, the Wall Street Business Network, and we have a number of other points here we want you to hear about that Michael's sharing with us. And we will be back in just a couple of minutes after these breaks. Stay with us. Don't go away.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. For more information on today's program, visit RE360radio.com. That's RE360radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We have special guest today, Michael Shelton, experienced appraiser who's talking to us about that process Michael, so talk to us about a little bit about how repairs and fix-up affect value.
Well, for a lot of the programs, especially FHA, if there's any safety issues or in North Texas, foundations are huge. I don't know if you have that problem there, but we have a clay expansive soil here, and so there's always everybody's always on the lookout for a cracked foundation or settlement, and so those type of things, if they haven't been addressed, will just completely stop your loan process. And so, you know, the cosmetic issues are important. The structural issues are crucial.
And in other states, whatever structural issues come up in those states, right?
Well, there's dampness in the basements. We don't have basements here, but in the East Coast they have basements there, and there's a lot of moisture in the basement. Those kind of things lead to mold and other health and safety issues. And basically, until you get those rectified, your loan's not going to go through. So before you ever place the house on the market, it's a good idea to go through and just make sure you don't have any what I would call deal killers.
Yeah, and I want to make sure too that listeners understand that they got to be careful in either buying a property or in fixing up a property. That you have to be very careful about not over improving for the neighborhood, right? If you have a home and you over improve it and you don't have you do an appraisal and you don't have other properties in that neighborhood that are at least as high, it's very hard for you to give that appraisal value that's higher than what's around it. Is that true?
Well, that's certainly true, and that's probably one of the biggest disappointments for someone who hasn't had a long history of owning single-family homes. That they purchased their first house, they put their heart and soul into it, and it's not unusual for us to come across around here a $150,000 property that somebody has remodeled and spent another $100,000 on the home in just repairs and scraped hardwoods and updates and whatnot, that the marketplace just doesn't support that much money for it.
You can give a little bit, but not a pretty small percentage of that over improvement.
Exactly.
True.
I mean, you may be, for every dollar you're spending on something like that, losing 90 cents to that dollar. So you need to pay close attention to what's the value range in your immediate market, and keep that in mind as you're fixing up the house. If you're repairing it because you've always wanted whatever it is you've wanted, plastered walls or what not, then that's fine. That's for your pleasure. But don't expect the market to necessarily help you recover as much money as you're spending on those updates.
Now, Ken, talk to the listeners about dealing with homes, foreclosed or distressed homes that are in that neighborhood. So to what degree can you disregard distressed homes and using them as comps versus ones that are in excellent condition? Talk to us about that. You go to appraise a home, can you disregard those distressed homes?
Well, you'll have to make note of them. There's a new form in all appraisal reports called a market condition form, and that's generally where we'll discuss how many of the homes in the subdivision or market area are REOs or short sales or whatnot. In this particular market, we don't necessarily have to use those as our comparable sales. That if you want the comparables, the ones that you're valuing your home against, to most represent whatever your subject is, the subject property, the one you're valuing. So, of course, we're going to use other owner-occupied homes, and we have a lot of those right now. A few years ago, though, there were no owner-occupied homes selling, and when the market's trending downward, the owner-occupied homes, they just decide to live in them, for another year and try it again in a different market. And so those aren't trading hands because they don't want to take a loss. And the only sales that you have are usually the REO properties, and that's a lot harder market to appraise in.
And that's a very good point. It's not a matter. It's not a matter of what homes are in the area. It's what homes have been sold, right? That just because you might have 80% of the homes in excellent condition in the neighborhood, but if none of those have sold and the only ones that have sold are distressed, you have a problem trying to support the price, right?
Exactly. And, during the underwriting process, most of the valuation models will pick up every REO that's in that subdivision And then you'll start seeing those, from the wholesale lender. How come you didn't, address this? And then, you have to go through each and every comp that's sold and mention, yes, I considered that particular comparable, but didn't use it because it's an REO and was missing all of its appliances or carpet or, whatever the issue happened to be. And those are just a lot harder. In that kind of a market, it's just a lot harder to get your loan to close and everything to go through.
Mm-hmm. Indeed. So it's in a this kind of market where there's more retail homes going, then it's not a problem. If you're having trouble finding enough comps for a product, what is the preferred approach? Do you go for? Well, I guess if it's as for the high volume market, they tend to want you to stick to like 3 months instead of 6. Correct?
Yes, and so if we're ever having difficulties, there's a multifaceted approach, and you don't know who the reader of your appraisal is, or who your audience is exactly going to be. So you try to do something that'll at least touch on everybody's hot button. But we'll go in a subdivision if there hadn't been any sales in the last 3 to 6 months. We may go back a year or two and include a couple of older, dated sales in that subdivision to support whatever value we're coming in at, and then go outside that subdivision and find the most recent sales that are consummated within 90 days or so.
But what's the preference?
Over a mile.
So what takes priority? Going back in time past the 3 months, or going to a different neighborhood that's more recent?
Well, on the single family forms you have room for 9 comps. So generally I'll do it all 3 different ways. Mm-hmm. I'll do one with all the 3 comps within 90 days, one with all 3 comps in the subdivision, and another set with all 3 comps within a mile and within date. And that way, no matter what flavor the underwriter's looking for, I've got something to address.
Okay, so you can do both. All righty, we'll be back in just a moment here for a little recap. This is KDOW, AM 1220. Tom Wilson with Real Estate 360. We got Michael Shelton with us today from Dallas, an experienced appraiser, and we'll be back with Michael in just a moment.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. For more information on today's program, visit RE360radio.com. That's RE360radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We've enjoyed our special guest today, Michael Shelton, calling in from Dallas and talking to us about the appraisal process. Well, Michael, there's a lot of elements involved that affect this whole buy-sell transaction that people don't realize, I think.
Well, there sure is, but I think it's worthwhile overall. I think that the appraisal is kind of it's part of the gateway to a high-leverage, transaction. So although it's cumbersome at the end of it, though, once you get through that, you get to buy a lot more house with a lot fewer dollars down. So I think it works out in the home buyer's best interest.
You see any changes coming up in the appraisal process the next few years? You went through quite a change here in the 2008 crash, right? And
right.
Was that what changes happened then other than not being able to direct the appraisal to a particular firm?
Well, when that in 2008, when that regulation went into effect, we pretty much all the lenders went to an appraisal management company, to where we lost the appraisers no longer are in direct discussions with most of their bank clients anymore, and so that was quite a financial crash for a lot of us appraisers, and a lot of them went out of business during that.
Well, we certainly understand that there was some fraud going on, but I think for the most part, it was, from my experience, it was a shame, because I think, you generally, when you communicate information back and forth, both parties can, the more information you have, the better you can make the process. But they wanted more arm's length, and so that's what we got to deal with.
That's it. So there's not much we can do about it except go on from here, right?
Well, it's been wonderful having you on the program, Michael, and we're going to have Michael back in the near future here, because Michael's a very experienced investor, and he's been that way been doing that for a long, long time, and he will be back to tell us about his investment experience and and recommendations that he has. Michael, thanks so much for being with us today. We learned a lot.
It's always an honor speaking with you. Thank you so much.
Thank you, Michael. So it was great to have him. I've worked with him a long time, and I got a better appreciation for what the appraisal process is about. If you would have some things you can go to my website for, TomWilsonProperties.com, and there are several things that are available to you. One is a report on macroeconomics and real estate, where it's going and what you can do about it. Another one you can ask for is about high tech to the heart of Texas. It describes the methodology and process that I've used. It's a 19-page report on how to select the best place and best products to invest in. We always welcome your questions that we can, and subjects that you'd like to have covered here on the air and on the program. Got a newsletter on economics that brings you up to date weekly on a 1-minute read as to what's going on. Next week we've got our program on photography and real estate. What are some ways that you can present your product better or get your agent to do that for you, so you've got a much better presentation or a better image of your product that you're putting out there. And again, that's TomWilsonProperties.com. Go there and put in your request, and we would love to hear from you. So be back with us next week, and be with us the other days for the Lori Graymont and Joe Kuchera. We love having you with us. Thanks so much for being with us on this program. We thank Michael. And remember, the only thing that matters is what you do next.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.